Hello, and thank you for joining us today. Our team of analysts include Crystal, Christina, and Stephen, and we will present the current financial situation of Costco Wholesale. Costco is a publicly traded American multinational corporation that operates a chain of membership-only warehouse clubs. Their mission is to continually provide members with quality goods and services at the lowest prices possible. They are headquartered in Issaquah in Washington State and have hundreds of locations in 8 countries. Costco is known for their large format stores, and they offer a wide range of products, often in bulk, including groceries, household essentials, and appliances, electronics, and more. They also provide services like optical, pharmacy, and travel, along with various member benefits and options like auto insurance and car purchasing. Costco operates in the retail industry, specifically as a membership-based warehouse club. Their biggest competitor is Walmart, particularly through its Sam's Club division, which operates a similar membership-based warehouse model. Other major competitors include Target, which offers competitive pricing on general merchandise, Kroger, who competes in grocery retail, BJ's Wholesale Club, another membership-based warehouse retailer, and Amazon, who competes in e-commerce and bulk purchasing. Costco has several strengths and weaknesses that shape its competitive position in the retail industry. First, Costco's subscription model ensures consistent revenue and strong customer loyalty, reducing reliance on fluctuating retail sales. Limited product selection and bulk purchasing reduce operational costs, allowing Costco to maintain low prices and an efficient cost structure. Through their private label brand, Kirkland Signature, Costco aims to offer quality products to compete with leading brands, often at a lower price point. Kirkland Signature's products provide high margins and customer trust, strengthening Costco's brand. For weaknesses, Costco offers fewer SKUs than traditional retailers, which may deter customers seeking more choices. They have a limited assortment of around 4,000 products, whereas most other supermarkets have 30,000 SKUs. A significant portion of revenue comes from subscriptions, making Costco vulnerable to membership declines. While Costco benefits from stable membership revenue, economic downturns can slow new signups, affecting long-term growth. Compared to competitors like Amazon and Walmart, Costco's online sales are less developed, making it more vulnerable to shifting consumer preferences. Costco consistently outperforms its competitor Walmart in key financial metrics, reflecting its operational efficiency and strong financial positioning. In terms of profitability, Costco has a slightly higher net profit margin and significantly stronger return on equity, largely due to its membership-based revenue stream and cost-efficient bulk purchasing model. Instead of relying solely on product markups, Costco generates a substantial portion of its income from membership fees, which are high margin and recurring. These fees contribute to profitability without requiring additional capital investment, boosting return on equity. Regarding asset management, Costco demonstrates superior inventory and asset turnover rates, indicating faster product movement and revenue generation compared to Walmart. Costco limits inventory, focusing on bulk sales and a smaller, more specialized product selection, which speeds turnover, minimizing holding costs and maximizing efficiency. Whereas Walmart has a broader selection of items in smaller quantities, which translates to a larger overall inventory. Costco also maintains better liquidity with higher current and quick ratios, ensuring stronger short-term financial flexibility. This is likely due to Costco's efficient inventory strategy, predictable cash flows through membership fees, and lower short-term obligations. In debt management, Costco relies less on debt financing, having a lower debt-to-equity ratio and significantly higher times interest earned ratio, reinforcing its financial stability. This is likely due to Walmart's diversified operations as a large retailer, which requires more financing, leading to higher debt utilization. Finally, in market value, Costco commands premium investor valuations, as reflected in its high price to earnings and market to book ratios, suggesting strong growth expectations compared to Walmart. Overall, Costco appears stronger in profitability, asset management, liquidity, debt management, and market valuation, collectively giving it a financial edge over Walmart. Its selective product variety, bulk sales, and membership-driven model create a more stable and high-performing company, reinforcing investor confidence and long-term sustainability.
This is Steven. In this section, we're going to go over Costco's capital structure. As we can see, the company primarily uses equity to finance its operations. It currently has about $1 billion stocks that are given out, 900 million of which are common, and about 100 million of preferred stock with a par value of 0.005 cents. As of May of 2025, the company currently has a total liability of $48.3 billion and a total equity of $27.1 billion, with $20.8 billion of that being retained earnings. This shows us that on average it has a low debt to equity ratio of about 0.23 in comparison to other giants within the industry like Walmart at 0.54 and Target at 0.47. As we can see, Costco's overall cost of capital is currently 6.8%. This is made up of 5.9% cost for equity, 4% for cost to debt, and about a 24.4% tax rate. When compared to other major retail competitors like Walmart, which is currently at 6.4%, and Kroger 5.83%, we notice that Costco's WACC score is significantly higher. This is likely because Costco uses less debt and relies more on equity, which is generally a more expensive way to finance operations. What this means for investors is that this business is seen as a little bit riskier and will need to compensate investors with higher returns to offset the level of volatility that is involved in the company operations.
Hi, everybody. My name is Crystal. So let's start by looking at Costco's governance and ownership structure. One of the defining traits of Costco's stock is that it's heavily held by institutional investors. Around 70 to 72% of the company's shares are in the hands of large firms like Vanguard and BlackRock, two of the largest asset managers in the world. Vanguard alone holds about 9.6%, and BlackRock holds just under 8%. Now, while this strong institutional presence shows a high level of confidence in Costco's long-term performance, it also means that the voice of individual shareholders and the company insiders is relatively small. In fact, insider ownership is less than 1%. Now, this brings up an interesting governance dynamic because Costco has a reputation for putting long-term stakeholders' value ahead of short-term shareholder returns. Now, they invest in employees, treat suppliers well, and keep prices low for customers, even if it means sacrificing short-term profits. Now, while this aligns well with Costco's mission and has paid off over the long haul, it can sometimes put the company at odds with investors who are looking for a quicker return or more aggressive growth strategies.
Next, we will go over Costco's investment performance. The calculated average 5-year return for the company is about 28.58%, and the 10-year average annual return is about 22.69%. With a calculated beta score of 1.0, generally means that the company has an average market risk and tends to move with the overall market. It pays quarterly dividends and even offers special dividends for particular investors. The current annual dividend is $5.2 per share. As we can see, the company has various outstanding bonds with a total number of about $5 billion in currently outstanding bonds, which we'll go over in the next section. One particular bond that we would break down is Costco's 4977644D bond, which has a current maturity date of April 20th of 2032, which is essentially 7 years from now. The year to maturity is roughly 4.4 to 4.9%. This figure can vary slightly based on when and where you check and what database you're using. It has a fixed coupon rate of 1.75%. It pays semi-annually, and the par to $100 face value shows that of 83.58 shows that this bond is actually trading at a discount. Again, the outstanding amount is $1 billion. The face value is $1 billion, and the minimum denomination is $2,000 for this particular bond.
Here's the conclusion. So, shifting to the big picture, Costco's overall financial position is very strong. They take a very conservative approach. The company's kept debt levels low, reflecting in their debt to equity ratio of just 0.23. They're in a great position to meet interest obligations with times interest earned ratio, TIE ratio of nearly 55. Now that's far ahead of competitors like Walmart or Target. This low debt burden combined with strong, consistent cash flows means that Costco is extremely well positioned to repay its outstanding debt. From a lender's perspective, Costco is a very low risk borrower. Now, this conservative strategy does come at a cost. Their weighted average cost of capital is 6.8%, which is higher than some of their peers. And that's because Costco relies on more equity financing, which tends to be more expensive than debt due to shareholder expectations for returns. So while this strategy provides Costco with long-term stability, it also means that they may not be raising capital as effectively as they could. Now, this brings us to a recommendation. So given Costco's excellent credit worthiness and their low cost of debt, currently around 4%, we think the company could benefit from incorporating more debt into their capital structure. Specifically, we recommend using moderate levels of long-term debt to fund strategic incentives like expanding global operations, investing in e-commerce, or improving supply chain infrastructure. Now, this would help lower their WACC or weighted average cost of capital and free up capital without adding excessive financial risk. Now, at the same time, we believe Costco should continue its current strategy around equity rather than issuing new common stock broadly to the public. The company has been using stock-based compensation for employees, which helps with their retention and motivation without diluting ownership too much. Now, this cautious use of equity aligns well with their overall conservative financial approach. Overall, from a portfolio or investment perspective, they're a great, strong addition. They remain a very attractive long-term investment. Now, over the past 5 to 10 years, the company has delivered average annual returns of roughly 28.6% and 22.7% respectively. That kind of consistent performance is well above the market average. Costco has offered a well-balanced risk and income profile with a beta close to just 1. The stock moves in line with the broader market, so it doesn't add excessive volatility to the portfolio. And with annual dividends totaling $5.20 per share, plus occasional special dividends, it's a solid option for both growth and income-focused investors. Now, the high level of institutional ownership reinforces the idea that Costco is viewed as a stable, trustworthy company. So in summary, Costco provides steady long-term value, and we believe that incorporating modest levels of debt in the future could further enhance the value of shareholders, or for shareholders. But overall, Costco's combination of conservative financial strategy, reliable performance, and shareholder trust makes it not just a retail leader, but a smart and long-term investment. Thank you. Here are our references. Appreciate y'all's time. Hope y'all have a wonderful day.